Now, there are also other items, there are also other assets that are primarily held for sale but are excluded from the scope of application of Pass 2, but only with regard to the measurement provisions of the standard. And the reason that they are being excluded from the measurement provisions of Pass 2 class is that by their very nature and by their usage of trade, they simply are measured differently. Common theme of these items class are that these items of inventory are, by their very nature and by the practices in the industry, they are to be measured simply at their net realizable value. One way of understanding class why these items are being excluded from the measurement provisions of the standard is that the entities who sell these type of inventories class engage in this kind of business not because of the markup that they will earn from these inventories class, but because of the volatility in the net realizable value of these assets. They expect to profit from the regularly changing value of these assets, not from earning markups after the asset is resold or after the asset is processed further. So the items excluded in paragraph 3 class are those that are, for letter A, can easily be sold at any point of the product's life, whether the product is sold as a raw material or sold after being processed further. There exists an active market for such item of inventory, and that is why the practice in their industry is to simply measure it based on its net realizable value. And as for letter B here, class, the type of inventory here pertains to commodities. They are items that are not anymore processed further, but because of the volatility in its price due to intense activity in the market for the purchase and sale of these commodities, broker traders would now buy and sell these items not for the sake of consumption but for the sake of earning on the margins, earning on the changes in its prices. So to recap, financial instruments held for sale, biological assets related to agricultural activity, and agricultural produce at the point of harvest are not governed by Pass 2 because they are governed by a separate standard, while inventories held by market players in select industries where the established practice is to measure the goods at net realizable value are excluded from the measurement requirements of Pass 2. Now, going back to the definition of terms, I think this is very important because this would help you remember the correct classification of your inventories. I might have failed to state earlier as to how cash is to be classified. Based on Pass 1, cash should be classified as a current asset. Now, as for inventories class, I want you to take special note of inventories because this is one of the few assets that does not permit multiple classification. As what we've discussed before, it's possible that an asset will initially be a non-current asset, but later on in its life, it will become a current asset. But for inventories class, throughout its life, it will remain as a current asset. And the definition of inventories will help us understand why. So inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, in the form of materials or supplies to be consumed in the production process or in the rendering of services. If you'll try to recall the definition of current assets provided in Pass 1 class, it would tell you that aside from cash, current assets are those that are held primarily for trading. And that is essentially what letter A in the definition of inventories is trying to tell us. Inventories are assets held for sale in the ordinary course of business. Translation, it is held primarily for trading. Next is that current assets are those assets expected to be used, utilized, consumed, and realized within 12 months or the normal operating cycle. And if you'll try to recall the definition of your operating cycle class, it is the amount of time it takes for inventories to be produced, sold, and the receivable ultimately collected. So basically, class, if it is an asset that is in the process of production for such sale, definitely it will fall within your normal operating cycle. If it is a material or supplies that is to be consumed in the production process, then definitely it will fall within your operating cycle. If it is expected to be used, consumed, utilized, or realized within your normal operating cycle, then definitely it will be classified as a current asset. So because of the definition of your inventories class, your inventories will always be classified as a current asset. Letter A represents held for trading. Letter B and letter C represents assets that are expected to be used, consumed, utilized, or realized within your operating cycle. So it does not matter whether the consumption or the realization will go beyond 12 months because they are related in the production class, and for the ultimate sale of those goods, then they will always fall within your normal operating cycle. And as what we have established before, even if it goes beyond 12 months, as long as it is within your normal operating cycle, the asset will still be considered as a current asset. Now, moving on to the measurement of inventories class, we will have to deal with two important terminologies here, which would be our net realizable value and your fair value. So this is very important class. This will be asked a lot of times. Net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. The simplest way of understanding this class would actually just lead us back to the phrase we are trying to define, which is your net realizable value. What is the net amount? What is the net value that you will realize if you will produce this good, if you will finish these goods and sell them ultimately at their estimated selling price. It's fine if you cannot imagine how this works yet, as long as at this point you will remember the composition of your net realizable value. We will have three components. First would be the estimated selling price. Next would be the estimated cost of completion, and the third would be the estimated cost to sell. So estimated selling price, cost of completion, and cost to sell. Estimated selling price minus cost of completion minus cost to sell. Now, fair value, as we may have encountered before already, is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value is relevant here because we can use the fair value in arriving at our net realizable value, especially with regard to our estimated selling price. So we have here in the standard, very important concept class, net realizable value is an entity-specific value because it takes into account the cost it will take for the entity to complete the inventory and to ultimately sell the inventory. Now, these two costs can be different for every entity. The estimated selling price for the same goods may be the same, but with regard to the amount it will take an entity to complete and sell the inventory, the cost to complete and the cost to sell may not be the same for different entities. And that is why the net realizable value is considered to be an entity-specific value, whereas your fair value should be equally applicable to everyone in the market. The amount set by various market participants, by your buyers and sellers, would be applicable to any market participant. So it is the market that sets the fair value, whereas the net realizable value will definitely vary from one entity to another. Now, paragraph 8 actually introduces us to the different kinds of inventories maintained by different kinds of businesses. If you're a merchandising firm, if you're a merchandising business, meaning you're engaged in buying and selling only, you sell the goods in the same state in which you bought them. No additional process, no additional improvement is applied on your purchased goods. You sell them in the same state you acquired them. And the inventory account that will be used by these kind of businesses would be the merchandise inventory account. Now, another type of business would be your manufacturing firms, those that start with raw materials to arrive at a finished product. They normally maintain at least three inventories. You have your raw materials inventory, which can include your supplies. Second would be your work in process inventory. This pertains to raw materials that have already been subjected to further processing but are simply not yet finished. And the third inventory account maintained by manufacturing firms would be your finished goods inventory. And these are now the items that are ready for sale. Now, if you will be asked, how are merchandise inventory classified? How are raw materials, work in process, and finished goods inventory classified? Again, our answer would be they are to be classified as current assets because inventories are to be classified as current assets.